Hi, friends. So, welcome once again. So, at this point, we're going to be taking a look into the intangible assets as the first item on our study. Okay, so we'll be looking at intangible assets and how it links up to the goodwill concept of goodwill. So, gradually, we will then move into the consolidated account because one key item we should be looking at when we're dealing with a consolidated or group account is goodwill recognition, measurement, and then disclosure on the face of the financials. But goodwill sometimes has a kind of attitude, in which case it may look like an intangible asset, okay? But goodwill is treated, yes, it is an intangible asset, but it's treated separately from all other known intangible assets. So this is what I want us to be looking at in the next few minutes. As usual, I'll try to keep the lesson so brief and concise so that studying it or reviewing the videos will not be too boring. So I'll try where necessary, I'll plug in my interactive pen and show the illustrations, take the annotations. Okay. All right. So we'll be fine. So let me share the screen whilst we take a good look into our intangibles and goodwill. Okay. So we are looking at intangibles and goodwill. Okay. But we are looking specifically on IAS 38. 38. Okay. Let's move on. So by the end of the lesson, we're looking at the fact that we can, we should, as a student, you should be able to explain the nature and accounting treatment of internally generated and purchased intangibles. Okay, and then distinguish between goodwill and other intangibles, like I said. And then the criteria for recognition, measurement of intangibles. We look at subsequent measurements after initial measurement. Okay, and we look at impairment testing. Then we look at purchase consideration for an investment, which will give rise to goodwill, to the concept of goodwill. Okay. And then in detail, we'll look at how we can apply the IAS 38 principles to research and development. Okay. And any questions you find around these areas, you should be able to understand and answer them easily. Okay. All right. So we're taking this overview. I think I would just plug in my interactive pen. So we're taking this overview, and if you could see clearly, I've populated this picture. Okay, so we're looking at IFRS 3. Okay, so our group account will stand somewhere. We'll revisit it on a different level. Okay, in which case we're looking at goodwill. Okay, so goodwill can be negative, in which case we call it the bargain purchase. Okay, we call it the bargain purchase. I'm just introducing it, so don't be worried. We'll get to it. What does it mean? Then we could also have a purchase goodwill or non-purchase goodwill. So they are intangibles, all right? But typically what we are more interested in at this point is the IAS 38. So we look at how it leads its leg into research and development. Which components of research and development should we recognize in the books? Okay. Then we also look at acquired intangibles versus in internally generated intangibles. So we look at its recognition criteria and then amortization. So again, we flipped this same thing over here to the left hand side as an overview. So we look at the definition, recognition, subsequent recognition, amortization, and then we conclude the study. All right, so let's move on. So the conceptual framework, it underpins all that we are doing. Okay, I will just pop up everything. Okay, the conceptual framework underpins everything that we're doing. Okay, so it is very important that we take a good look at it. There's a link I've put on Moodle which gives you this same conceptual framework stuff. Okay, so you need to create, ideally, you need to create an IFRS account to gain access to this. Try and create it. It's nothing, it doesn't cost anything. Okay, it's just free. So you must read and understand this context. So, like I'm saying, the conceptual framework underpins all of accounting standards that have been issued. Okay, so it's more or less like the framework, the embodiment within which we have kept all these statements, these financial standards. Okay, so look at it like these principles and concepts and standards we are referring to. Okay, when creating the principles and the principles and concepts we refer to when creating, when modifying, when issuing these standards. Okay, don't be surprised that along the line standards will still be evolving. Today we are having sustainability accounting standards, which tells you that more standards will be issued. So when you have an interview, for example, with a company for a job, for an exams, it is always important that you have to go on the internet, you research about the principles, okay, and see what core values the company abides by. That's what you do, don't we? The same way with the conceptual framework is giving us those core values, the principles within which these statements operate. Okay, so it has legs. It has legs that I want us to look at. So it has its qualitative characteristics of any financial statements. Okay, so the conceptual framework has its fundamental qualitative characteristics, relevance, faithful representation, okay, reliability, name them, okay. And it has underlying assumptions, which has to do with going concern, assumption, accrual concept, prudence concept, okay. So these are elements of the financial statement that helps us to implement the standards as required, okay. So it gives us a clear-cut objective of the financial statements, when to recognize, when to measure, okay, on which principle are we doing all of this, okay. And it gives us various angles within which we'll be able to understand what is an asset, what is a liability, what is a contingency. So more or less, it is a matter framework, a theoretical framework within which you can always apply your financial statements. Okay, so it covers both the IAS and then the IFRS. The conceptual framework covers all. It's like a platform, a foundation upon which we build these. Okay, so that's what I'll say over here. Try and read more on this. I will not dwell so much on this. Now, intangible assets. What does it mean? If you take a good look at, sorry, going too fast. If you take a good look, okay, something is happening. If you take a good look at the IAS standard 38, standard 38, just a second, I want to hide something so that I can, okay. If you take IAS 38, okay, paragraph 8, it tells you that intangible assets are identifiable. So we can easily identify them. Non-monetary assets, they have no physical substance. This excludes goodwill. Goodwill, we'll get to that. Okay, this excludes goodwill because goodwill in itself is non-identifiable. You cannot separate goodwill from the business. Okay, let's say Amazon. Amazon, the good name that Amazon has is its goodwill. When you take off Amazon, I just write Bezos. Yes, he is the owner. If you don't take care and somebody creates an online platform with Bezos, people may not even patronize. But Amazon is identified to the assets, to the company. Okay, all right. So you cannot split them. Separability is the key thing over there. But intangible assets, we are talking of those items which are identifiable. They can be separated. We'll look at the definition, the difference between these. Okay. So in terms of identifiable, we are talking of able to identify. In order to identify the asset, it must be separate from what is being sold. So you have a license to operate. You have Stata software. The company which is issuing Stata may not have the same name as Stata, for example. Okay, I'm not too sure of that. So the intangible asset should be in such a way that it can be separated and we can sell that one or buy that one separately from the rest. And it arises from contractual or legal obligations. How do we recognize it? In order to be able to identify or recognize these intangible assets, it must meet the above criteria that it can be separated, okay, and it has a prospect of generating future economic benefits, and we can measure it reliably. These three always helps us, okay. Again, we mentioned in the definition, they said it's a non-monetary. So they are not cash or cash equivalent, not investments or cash at bank. And they are assets. Remember, they are assets. So they meet the definition of assets. They are acquired as a result of past events. They have the prospect of generating future economic benefits. And we can measure it reliably, okay? And it has no physical substance. You cannot touch it, okay? So like a trademark, you cannot touch it. Okay, a brand, you cannot touch it. Okay, so look at that. Even if it's a title, even if the title to it is a legal contract, a paper which supports the license is tangible, the actual asset, you cannot touch it. Okay, software license, you cannot touch it. All right, but the software may come in the form of a package you could hold and run it. Okay, so they come in two forms. That's what I want us to know. So intangible comes in two forms: goodwill and the others. Okay, so goodwill is specifically treated under IFRS 3, which will form the crust of our consolidation process when we start that. But here, we are looking at those assets other than goodwill that meet the criteria of IAS 38. Now, again, I said the difference between these two is separability. In terms of IAS 38, you can actually separate the item from the business and you can sell it separately. Okay, you can sell it separately. But goodwill, you cannot separate it from the business. Tesco is the good name. Okay, Facebook is the good name. Today they tell you that Facebook has changed to Meta something. Okay, so the good name of Amazon cannot be separated from Amazon. All right, take this. It makes life easy for us. Okay, both types are recorded as intangible. No worries about that. So you can see a brand or trademark and it is recorded as an intangible. And you can see goodwill, and it is also recorded as intangible. Therefore, it tells you that either of them can be impaired or they can be depreciated. Okay, we'll look at the terms which are associated with them. Normally, we don't use depreciation, we use amortization or impairment. We'll look at that. Okay, all right. So the recognition once again, identifiable. You can distinguish it from goodwill from others. Okay, control is exercised over the asset if the entity has the power to obtain it. So I have the power to obtain a license to use software. I should have the control to be able to use it to obtain future economic benefits for the company. Okay. And there's always the existence. Remember, it is an asset. So it must meet the definition of an asset, in which case we tell you that it helps in deriving future economic benefits to the company. All right. Recognition criteria. When? How should we recognize this? Okay. Now, the basic recognition is the same for any other assets that you can think of. Any tangible asset which you treated in financial accounting too. Okay, the same recognition criteria. That one, it should have the propensity of generating future economic benefits to the assets, to the company. And this must flow ordinarily from the use of the assets. Okay. The second thing is that the cost must be measured reliably. It meets the same recognition criteria for assets, okay, in definition of assets under the conceptual framework. So an entity should be able, but the subsequent one we should also know is that an entity should be able to assess the probability. What is the probability of future economic benefits we will derive? And the estimation should be based on reasonable and supportive assumptions, okay, which will be able to estimate a set of economic conditions useful to the life of the assets, okay. But again, remember some of these additional criteria. Um, Once we are able to better define its limits, its boundaries, it helps us to clearly distinguish these intangible assets from the tangible assets. So there are another recognition criteria that makes it quite complicated, and that is the circumstances under which it is created or circumstances under which it was generated. Okay, in which case it can impact whether we should recognize it or not. There's an interesting leg we'll look at, okay, in terms of internally generated intangibles. So the circumstances under which we acquire the trademark, the brand, name them, the patent, will tell us whether we should recognize it or not. Did we buy it off the shelf or did we generate it in-house? Moderna, Pfizer, this is a software license they use to create a vaccine. I cannot just get up and go and use it. The question is, there was a lot of research they did to come up with Moderna, with Pfizer, with AstraZeneca. There was a research. After that, they then developed a prototype, the development phase. Then they came up with AstraZeneca or Moderna. It is a license they use to produce the vaccine. Now that license, no, some Tesco cannot wake up and just say, I've also developed a product called AstraZeneca vaccine. No, they cannot use it, okay? But the question is, the company that developed the vaccine, okay, the license they use, the software they use, the process they use, okay, that ingenuity, that knowledge, when should we recognize it? How? Under which circumstances? So that's what we'll be looking at, okay? So the intangible assets are normally created in three number of ways. Like I said, you can purchase it off the shelf. You can also acquire it when you buy a company. So if I buy Amazon today, I can decide to acquire the name Amazon as part of my intangible or a patent. If I acquire a company that developed AstraZeneca, I acquire it, okay? So it comes about as a result of business combination or internally generated. I generate it within. I don't buy it off the shelf. I don't merge with a company to gain that asset, but I can generate it internally from research team that I have at my disposal. Now, the first two groups of intangible assets are usually recognized, the one we purchase off the shelf and the one with business combination. But internal generation, it has some criteria that it needs to meet. Okay. So again, the cost must be different, must be recognized. Um, when we buy it off the shelf, we bought it with money, with cost at historical price. We recognize it at cost. But if we acquired it as a result of business combination, then we look at the fair value using market indicators. That one will be used in recognizing. Therefore, it tells you that recognition of intangibles come about using two methods. The measurement is in two, the cost and the fair value through revaluation. Okay, so those are the two. No, just take note of them over here. How do we recognize? What is the method we use in measuring intangibles? If you bought it off the shelf, the cost at which you bought it. If it is through business combination, then we are going to use the fair value through revaluation. So we have the cost model and then the revaluation model. Okay, all right. We'll look at that in a bit. Okay, so like I said, measurement has to do with cost model and revaluation. But again, if the intangible has lost its value over time, and it depends whether it has a finite lifespan, it has a useful lifespan, or it has an indefinite, then we'll look at it. We'll look at it. Okay. Then if there's any amortization, reduction in value of the intangible, it is another cost model. It is the cost that we bought, that we issued to buy it, minus the amortization to get the net value. If it's a revaluation, we revaluate on the market, looking at market indicators. So the revalued amount minus any amortization, all right? So the revaluation model is rare in practice, as its use would demand the existence of an active market for you to compare. So if there's a patent I'm using, and I think that the patent, the value has increased or decreased, we need to get an active market which we can use at an arm's length transaction to benchmark and see whether the valuation, the new value I'm placing on the patent is consistent with market development or market or a similar product which has the same features as my patent. Okay, so the active market, like we said, should have homogeneous, identical products I can compare to. So if I have a patent called ABC patent, and it also produces vaccine, I need to be able to have an active market like AstraZeneca, Moderna to benchmark it. And we also have willing buyers and sellers. Okay, it helps us to know the demand and supply situation in terms of pricing. Then do we have available prices on the market? Okay, that's it. So now let's move on. Intangible assets should normally be measured at cost, initially at cost. Okay. So the purchase intangible, we have four modes of acquisition. Separately acquired. If you acquired it separately, it's easy to identify the cost, right? If you acquired it as part of a business combination, we can easily tell the market, okay, tell the cost. We can easily separate the identifiable parts. And again, if we acquired it by way of a government grant, the government gave you a grant, okay, and you can easily identify the cost. Or sometimes in terms of exchange of assets, I give you AstraZeneca, you give me Moderna. So we can always tell the cost reliably, okay. Now, internally generated Intangibles are usually split into two, like I said, in terms of the vaccine situation. There's a research component, there's a development phase. In terms of the research component, none of the cost incurred during the research should be capitalized. It should be written off straight as an expense into the statement of profit and loss. Okay, so all research expenses should be written off in the first instance. Okay, in the first instance should be written off. Okay, we'll look at another dimension of this in the next video. Okay, we'll look at another dimension of this. No intangible arising from research should be recognized. Okay, expense it. The development phase, you can only recognize or capitalize it if it meets all of these criteria, the pirate criteria. Okay, something has changed over here, but that was what, when I look at the recent publication from ACCA, they used a different caveat over there for the pirates. Otherwise, it used to be different, okay, but it's almost the same, okay. So the P is saying that it should meet the definition of an asset. Would there be a probable flow of economic benefits arising from the use of the assets to the company? P. I should be the intention for us to complete it, to use it, or to sell the product. Okay, that's the I. And then R, usually R used to be the resources. There should be resources available to be able to complete. But the recent text I saw says that R should actually be reliable measurement of the development cost. Okay. And then the A, initially, the A used to be ability to be able to complete the development. But here, A is actually the adequate resources available to complete the project. Okay. And then T is always has been the same. Is it technically feasible for us to complete the development of this asset? And then E. E used to be the fact that the expenses should be measured, expenditure should be measured reliably. But now the standard says that it should be expected to be profitable. Okay, which is quite questionable. But either way, if you use probable, intention to complete, resource availability, ability to complete, technically feasible to complete, and expected or expenditure to be measured reliable, it should be correct. The reason why ability to complete is because it more or less fits into technical feasibility. If it is technically feasible to complete, then it is assumed that we have the capacity or the ability to complete it. All right. So that's the pirate criteria. The development phase of the intangible should meet all of the pirate criteria before we can capitalize it. Okay. So they fall into two groups: the ones we recognize and the ones we do not recognize. Okay. Under IAS, we recognize development cost. IAS 38. Okay. But under IAS 38, we don't recognize research cost. Goodwill stands alone under IFRS 3. Brands are not recognized, customer lists are not recognized, and mastheads are not recognized. So the main reason why research and development costs are split, one portion recognized, the other not recognized, is because of one. Research is more theoretical. Do you know the number of companies who have invested in researching to produce COVID vaccines? But how many came up? Just a few. Okay. So research can be theoretical, exploratory. Sometimes doesn't lead to any tangible development of anything good for the society. Just a waste of resources. Okay. Gone were the days when research and development was capitalized, formation costs were capitalized, but nowadays those things are strictly being regulated. But development costs, they bring about a product to the market. It has resulted in a vaccine which is saving lives. So we need to recognize it. Therefore, we must capitalize it, not expense. Okay. Examples of research and development costs. Research, like I said, you're searching for new knowledge, you're finding how to apply some research applied knowledge. Okay, you're searching for alternative ways of doing things, devices, products, services. Development costs. Examples include models of prototypes, new design of tools, jigs, molds, dies, pilot plants, alternative materials and devices which have been developed. Okay, so one is more of seeking knowledge into, and the other one is about implementing, executing it, bringing it to life. Okay, the one which brings to life is what we should capitalize. The one which is typically seeking knowledge and not bringing it to life should be expensed off. All right. It makes sense. Okay. Otherwise, everybody will come up with some flimsy excuses of undertaking research and then capitalizing it just to be able to reduce their expenses and then boosting profits. Okay. Now, recognition. Let's look at this. Okay. At initial recognition, what do we do? And measurement. Okay. Like I said, subsequent expenditure should be expensed, recognized as expense. Any subsequent expenditure that you've incurred after the development, okay, after the intangible should be expensed, except in some rare cases. One, if only the subsequent expenditure led to enhancement of the assets. So it led to a booster development. Okay, so in the first case, it was a vaccine, a first dose, second dose. But the subsequent expenses actually led to develop a booster which may be different from the first and second doses of the vaccine administered. In which case, it will help to even enhance further economic benefits to the company as a result of the use of the assets. So there's a software we are using. The software can undertake all basic statistical analysis, but when we added some embellishments, some upgrades to it, it will not only do the basic statistical analysis, it can undertake advanced statistical analysis. In that case, we need to recognize that modification as part of the cost of the asset. Okay. Secondly, these extra costs which has been incurred we should be able to measure it reliably and attribute it to the assets. Okay, IAS 38 paragraphs 18 to 20. All right. Again, we mentioned two models under which we will be assessing the measuring it. Okay, cost model, okay, and then revaluation. Like I said, the cost model, what we've purchased, minus any amortization, any impairment. If it has lost value, subtract it. Okay, then you report the net value. Revaluation, we look at the revalued amount. Okay, and then we compare it to the carrying amount, what has been recorded on the books. That's the carrying amount. But what is the fair value on the market? Actually, this patent is selling like 1 million, but on our books, it is 800,000. So compare what is happening, the fair value on the market, to what the carrying amount is. Okay, and then subtract any amortization or any impairment losses which has been incurred. All right. Similarly, if the fair value on the market is 800,000 and on our books it is 1 million, then we need to use the fair value. Okay. Revaluation will deal with the fair value, not what is on the books, not the carrying amount. All right. So take note of that. So fair value, we need to reference it to an active market, something we looked at it. Okay. And always under revaluation, these revaluations must be made frequently, regularly, okay, to ensure that it is always up to date with the market values. Again, any increases in the intangible carrying amount, the carrying amount on the books, any increases is a gain. Okay, so if on the books we are having it to be 800,000, but it happens that after revaluing we saw that it has gained, there's an extra 200,000. That 200,000 must be credited directly to what? To the revaluation surplus. Okay, and then the debit goes to the assets account. Okay, to the intangible account. Unless the increase is actually a reversal of a previous loss. So unless in the past, let's say the 800 initially it was let's say it was 900, and then when we did the revaluation it was 800. There's a loss of 100. Therefore, we have recognized it as a revaluation decrease. Therefore, any other gain we get will have to be used to reverse the revaluation decrease. Okay. Otherwise, any gain on revaluation, credit it to revaluation surplus and debit the corresponding amount to the asset. Similarly, any decreases should be expensed directly into the income statement, unless any decrease is used to reverse a previous increase which has been recorded. If there's a previous increase we have pushed in the revaluation surplus and subsequently we've made a loss, a decrease, we just run it into the revaluation surplus account to reduce the previous increase we have recorded. Okay, so IAS 38 paragraphs 85 to 86 gives us this definition. Take note of this. Okay, take note of this. All right. Now, as I said, any intangible could have a useful life. If it has a useful life, it's useful for 5 years, for 10 years. Then always amortize it over its useful life. Usually we use a straight line, unless we think there's any other appropriate method to use. Okay. But if it has an indefinite life, not an infinite, it's different saying infinite. Infinite means it will live forever. Okay. But we are talking of indefinite. Indefinite. Indefinite means we are not too sure now. Okay. But if it is indefinite, it means we cannot amortize it. We only undertake impairment. We review it annually to check whether the value has reduced or not. Okay. So impairment assessment is done, and this must be done frequently. Okay. So I'm giving you this task. Try to find out which factors need to be considered when we are estimating an intangible asset useful life. And you can find this under IAS 38 paragraphs 90 and 94. Okay. So the current IAS standards. Okay. Try and find out and see if you can get some understanding there. All right. Now, goodwill, we know what it is. It is an intangible. But remember, it cannot be separated from the company. Okay. Usually, goodwill arises when we have paid an amount for a company and the amount exceeds its value, fair value of identifiable net assets. For example, if Amazon and its assets, identifiable net assets, is worth $100 billion, and I go in to pay $110 billion to acquire Amazon, the extra 10 billion that I have paid in excess of its fair value or the fair value of its total accumulated net assets is what we call goodwill. Okay, so you are paying more than the fair value. It's a goodwill. All right. Now, like I said, so the reverse is true. The reverse is what we call the negative goodwill. So the negative goodwill is and accounting is quite interesting. We don't call it negative goodwill usually. We term it the bargain purchase because you have bargained well and you bought it at a lower price. So if the identifiable fair value of the fair value of identifiable net assets of Amazon is $100 billion, and you go in to negotiate with Jeff Bezos, and you end up buying it for $80 billion. You have saved 20, haven't you? You've saved 20 billion, all right? So that buying it for less than that value is what we call negative goodwill or bargain purchase, okay? Now, like I said, goodwill can be purchased off the shelf. Okay, we can normally purchase it as we acquire a company, or we can sometimes not purchase it. Inherently, we develop it over time. All right. Jeff Bezos decided to run his business starting from a garage. He did not buy Amazon off the shelf. You know, Amazon is used to be this forest with, like I know, Amazonians, okay? But this is what he used. He developed the name, and over time, the name has come to stay. Facebook developed the name, and it has come to stay. So you can generate it inherently within, okay, over time, okay? Can over time. All right. So I'm giving this illustration. Let's try and solve this, and then we can wrap up with the disclosure. Okay. So a company develops a product at the cost of this. Okay. It is anticipated that the product will have a high demand for how many years? 4 years. Annual production for the next 4 years, totaling 16 million units, is split as this. Okay. It's split at this. Add this and see if you will not get 16. All right. So, yes, 9 plus 9. Okay, that's it. Okay, yes, 16. Explain how the development cost will be amortized. The development cost, it was developed at this. Useful life, 4. Very easy. How will it be amortized? So simply, we amortize it over a straight line. Its useful life, okay? So in the very first instance, and you must amortize it in relation to the production. Don't simply divide this by 4 and write off each one. No, don't do that, okay? So in the first instance is the 400,000 times how many? For year 1. Year 1 is 3, okay? So it is the 3 over the total 16 multiplied by this. Okay. Don't be tempted to easily write it off by dividing it by 4 because it's useful life. No. So we have to find the weighted average, each one over the total weighted average multiplied by the 400. Okay, that's what we do. And at the end of the day, when you sum all of these up, it should still give you your 400. Okay, give it a try and see. Okay, give it a try and see. And you realize that you should get this straightforward. Okay. So that is it. So IAS 38 suggests that amortization based on sales revenue, that's very important. I want you to look at it. Based on sales revenue should not usually be appropriate because the factors that affect sales are different from what affects the assets. So you're talking of inflation, pricing policy, discounting. No, those deals with the sales, but not production. Okay, so assuming this has to do with the sales, assuming this has to do with sales and not production units. If this was sales, okay, and not production units, then we cannot use it. But we always want to be sure it is based on production units, not the sales. All right, take note of this. All right. So we end by looking at recognition, derecognition, and disclosure. Once the assets we sell it off. Once we dispose it off, we derecognize it from the books. Like the same thing you do for tangible assets. Okay. And again, when you realize that there are no future economic benefits that will flow that are expected from its use or its disposal, you derecognize it. Okay. Now, any gain or any loss we realize from the derecognition should be the difference between the sales proceeds. Okay, difference between the net proceeds actually, and then the carrying amount. So look at the fair value or the whatever cost you have minus uh, and then look at the net proceeds, the amount you have, okay, the cost or whatever the value, less any amortization, any impairment, okay, and then against the net disposal proceeds, okay. If you sold it for 100 and there was some sales cost that you incurred prior to disposing of, okay, look at that one and compare it to the carrying amount in the books. The carrying amount would then be the cost or the revalued amount less the amortization and compare to the net proceeds. So that will tell you whether there's a gain or there is a loss. It's the same as realizing a gain or loss on disposal of assets. Similar, okay, same process works there. One thing we should look at is that again, it shall be recognized as profit and loss once you derecognize it, unless you are dealing with leases, in which case we are looking at sale or lease back. We'll look at that one differently. So under leases is quite different. We'll look at that one, okay? And remember, any gain on disposal should not be classified as revenue. No, you should classify it as gain on disposal of intangible, all right? Disclosure should be very detailed, long and detailed, okay? And make sure you provide all useful information necessary to help anyone understand what you have presented, okay? This should avoid any confusion. Now look at the financial reporting text, ACCA, the one we are using, and try to attempt questions, test your understanding, the TYU 1, 2, and 3, and the pages are 68, 69, 71. And then let's share the answers, okay? The solutions are within. So at least you try to work it independently and compare your answers. And then when we meet, we'll try to resolve it. Okay. So thanks. We've gone 38 minutes. So I'll end it here and I'll see you in the next session. Take care. Bye-bye.